Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. Pleased to be joined by two of my favorite guys in the industry, Zach Harris and Hunt Rose from TrueCore Properties. This is the second time we've actually had them on the show, and you'll see why they're favorite guests of mine once we start diving into this further. But first, Hunt and Zach, thanks again for joining me on the show.
Yeah, thanks, Chad. Really happy and excited to be back. Appreciate you letting us come back on, and I guess that means that we did a good enough job last time that uh you trusted that we weren't going to screw this up the second time around. So thanks a lot.
Yeah, thanks for having us. Always fun and been great to be a part of the community.
Yeah, I'm glad to have you as part of it. And we got to hang out actually last time and have dinner at the last SIOR conference. So are you guys
Yeah,
going to Vegas in May here?
we might be there. We might be there. Checking the schedule still. For sure, gonna go to the Louisville Fall event in Louisville, Kentucky. And got a busy travel schedule otherwise too. So
Yeah,
Well, I
we've
know you
got
guys are.
we love the SIR network, and I've got baby number two on the way, so I probably won't make Vegas, but Louisville will be there, and we like I said, that SIR network across the country has been one that has been extremely valuable to us. I mean, obviously, everyone that's part of that fraternity, very well qualified, and they do a great job at those conferences.
Yeah, they really do. I know you guys are super networked and you go to a lot of industry events and you really take a lot of time to be involved in the community, not just in networking events, but on social media. And we'll do a deep dive into your investment thesis and your buy box and how you guys are looking at properties right now. But first, just on the topic of networking, wanted you to tell the story about Alex. And from the last podcast we did, if you could tee that up real quick.
Yeah, Alex Rouge, Elfin Realty down in Baton Rouge. We had from the first conversation we had with you on the podcast, had a handful of folks reach out, which was awesome to connect with people that probably otherwise we would have never had an opportunity to connect with, and Alex was one of them. Great broker down there in Baton Rouge and covering some other markets in the southeast, and he reached out. He had an off-market opportunity at the time, and we chased it down with him and looked at a few live opportunities over the next few months, and just kind of got to know each other better. Got to know what he was working on, and what our buy box is and was, and happened to come across a FedEx facility there in Baton Rouge. A lot that we liked about the Baton Rouge market. Louisiana hasn't been strategically a market that we went out of our way to focus on, but as we got under the hood of the market, um, very limited supply, very little new construction coming online, and a very functional box in the heart of town, really well located to population bases. It checked all our boxes with a below market rent and a really strong credit. That it was one we jumped at, and it was an opportunity that would have never come about if we hadn't been able to join the podcast. So we appreciate it, Chad. Adding a lot of value to us, and fun to have a success story out of the podcast where someone reached out purely based on the podcast, and we were able to chase things down. And it's a story that has played out with multiple different brokers in multiple different markets. That has been a result of the podcast, but fun to get one done with Alex there in Baton Rouge.
Cool story. And yeah, I love hearing that because it's a true win-win-win. You guys get introduced to new brokers. Brokers have a chance to reach out to you and the guests and present opportunities. And then for me, I get to have this very cool platform that connects people. So I love it. I love hearing stories like that. And I'd emphasize as well, I don't look for anything on this. I'm not looking for a thank you or even and nothing. I just love having people get connected, and I'd encourage anyone listening, if you wanted to just reach out, if you want to present deals, if you just want to perhaps ask a question. The people that are coming on, and Zach and Harris are complete examples of this that are just open to chat and want to do deals and are actively looking. So I'd encourage anybody to just reach out and talk to the guests, and always leave contact information at the end as well. So yeah, gentlemen, thank you for that. I really do appreciate that.
One
Yeah,
thing I'd
sure.
add to that, Chad, is I totally agree. And one thing, I mean, whether it's some folks met on social media or through the network that you've created, Chad, and the community you've created, everybody has been so willing to jump on the phone and connect. I know Zach and I have learned a ton from talking to different folks in the network, to listening to some of the other podcasts you've had. So please do reach out. I mean, we love connecting with, whether you have a deal today or, maybe it's 18 months from today. We love making connections. Like you say, Chad, we just like talking about industrial real estate. So be fun to do that. And back to SIR, I think SIR does a really good job of, in a world that sometimes people kind of keep their arms around information and data, really refreshing the level of sharing in all these different communities.
I completely agree. Zach, were you going to add something on that as well?
Yeah, I was just gonna say it's really, we subscribe to the philosophy that the rising tide lifts all boats, and to what Hunt was saying about the network, and about who we're talking to nationwide. It's been awesome to really establish those relationships where you subscribe to the abundance theory, that we're all trying to help each other. We're all trying to be successful, whether it's what you're trying to do in brokerage or on the acquisition side, or any other aspect of the commercial real estate industry. And so we're just big proponents that it's all about establishing relationships, networking, being a sounding board, and helping anybody out when you can, and vice versa. So we all know that it's a relationship oriented industry, and honestly, that's what makes it super fun for Hunt and I day in and day out, is just the people that we get to talk to, and the just the impressive resumes of the people that we get to work with. It's really fun.
We were joking before the show that this lamp above my head, we turn it on for a good idea. Like, this would be a good time to turn it
Yeah.
on, because I love everything that you guys said on that. I can completely agree. So let's jump into that, and Hunt, maybe I'll start with you on. I want to do more of a deep dive than we did on our last episode, where we talk about your buy box, and then also the strategy behind it, and then why even industrial real estate. So let's actually start there, because we'll tee it up with why you're bullish about industrial real estate, and then we'll move through into the buy box and your strategy and your thesis behind it. But I'll start with you, and then we'll move over to Zach. Why industrial real estate in the first place?
Yeah. So just backing up even a little bit further, we all have a background in as investment sales, brokerage, brokers. We worked at Stan Johnson Company for a number of years, focusing on net lease investment sales across the country. Our primary focus on the team we were on was in net lease industrial. But over the years, we had an informal-ish investment arm within Stan Johnson Company. We did a lot of different things, a lot of different asset classes. And when we were looking to form TrueCore Investments, who we are today, we really took a step back and said we don't want to chase a lot of shiny objects, and we want where do we think there's opportunities? Where do we think we have an expertise that we've developed and can continue to develop? And then where can we compete, and what's our competitive advantage? So that's when we really honed in on this Class B industrial asset class. Our buy box is, we're looking at, call it 2 to 15 million on a per asset size. Typically, that's 20 to 150,000 square feet in terms of the building size. We like industrial outdoor storage as well. We like a combination of a building with some excess yard area. And then we're looking in top 150 markets across the country. I can go into why we believe in some of those secondary and even tertiary markets. But essentially, population size is 400,000 and above. We need some level of a population, and of course, like the trends of population growth and some of those net migration trends, we of course look at. And then as we also are typically buying with a lease in place. Given our background with in the net lease industry. We're not buying a lot of vacant assets. We're typically buying with a lease in place. We do have a value add strategy. So to us, that means we are underwriting a 5-year investment period or less. So we've done some shorter term 12-month investments all the way up to a 5-year where we're trying to create value over that 5-year period. And typically where we're working towards a 200 basis point spread on our stabilized yield on cost is ultimately the goal there. So typically what we're buying are properties with below market in place lease rates that we feel like there's some upside at the expiration of the current lease term. We're buying at a significant discount to replacement value. And then the biggest thing for us, because it is a value add strategy, and what we are doing is buying a lot of these properties with shorter remaining lease terms. We have to have a functional building, and that's what it boils down to. Because if we're willing to take that renewal and vacancy risk at the end of the current lease, we've got to have a box that we feel like would be in demand and re-tenantable for a future user. So that's what we love about. What we also love about the Class B space is the adaptability and flexibility of a lot of these boxes. Given the infill nature and location of a lot of these, there's a ton of flexibility on the different types of users that can use these facilities. So we've seen, a whole list of different users and different use cases, whether it's pure industrial to manufacturing to even, there's a lot of retail-ish. Not that that's a strategy for us, but retail-ish users that are absorbing space in the smaller Class B, small to mid bay space. So that's where we're focusing all of our time and energy, and really just hyper focused on that what we call value add Class B industrial.
Actually mute. Oh, sorry, in the background. I'm on location right now. I'm not in my normal studio. Let me just see how I can mute this. Oh, I think we got there. So yeah, thanks for explaining that. That was awesome. I want to dive into why industrial. So I think that buy box makes a ton of sense in terms of what you're looking for. 150 markets. I think if anybody's listening, that's very encouraging, because there are some firms out there that will only focus on the big markets. They might only look at 10 of the major markets. So to hear that you guys are interested in 150 is probably encouraging to a lot of people out there. Why industrial real estate? I'll turn this one over to Zach to get his thoughts on there. But why industrial real estate? We're in the industrial community and we live, breathe, and sleep this. So this is all we think about. But if you're explaining this to somebody that isn't familiar with industrial, whether it's an investor or just someone that's curious on this, what's the bull case? What's your thesis on why industrial is the asset vehicle?
That's a great question, Chad. And honestly, something that if you think, like, we're in the weeds so much every single day, and we've defined this as what we're going after. So to step out and be like, why are we doing this again? It's always a fun exercise, but sometimes it's, sort of that existential question, like, why are we doing this again? But honestly, it really comes down to, for me, it comes down to the supply chain and the ever evolving and modernization of the supply chain, and how goods, get moved from, the point they're made until the point that they reach the end consumer. And what we're seeing today, and what we're going to continue to see, is that, there's a need for industrial warehouses to store the product, to help make the product, and to help get the product to the end consumer faster and more efficiently. And so to do that, you need more space. You need last mile facilities that are close to customers. You need outdoor storage space to lay down build materials and equipment, construction industry, all of that stuff. So just as our population grows, and the way that we consume goods and services evolves, and how we access those, with the internet, not necessarily brick and mortar, solely anymore. So it's just this changing patterns that we've all seen in society, and the backdrop of all of that is this insatiable need for more industrial space that companies need as they evolve their long-term business plans. And so we see that being a trend that is not going anywhere anytime soon and is essentially going to continue to become more prevalent. Um, and then sort of dovetailing on that, why we really like Class B within the industrial space in general. Hunt touched on it a little bit, but it's really just, okay, where are these Class B facilities? They're older. They were built, 10, 20, 30 years ago. They have maybe a little bit lower clear heights than what Class A facilities are. But the good news is that they were built when the cities that they're located in were smaller. And so generally these Class B facilities are closer to the population bases in the center of cities. Well, a lot of the service companies and a lot of the, kind of smaller industrial users, they want to be kind of more in that bullseye in the market. And the Class A stuff is getting built, around the rings of the city where there's available land, right? Available and cheaper land. Um, and so for us, being able to go buy a well-located product and a functional building in a market, and we talked about these secondary markets, maybe that haven't experienced this, Class A spec development boom that we all saw over the last, 5 to 7 years. So these markets are already supply constrained anyway. They've got, 3% or less overall industrial vacancy. When you look at Class B specifically, we're talking in some markets 1 to 2%, which is virtually, virtually no Class B industrial space if you look to the market, especially if you're looking for a specific size range of product. And so what we've been seeing is that, these secondary markets can be really, really strong and under the radar, especially from an institutional investor perspective. But the dynamics are there such that the Class B facilities that we're buying are really, really in demand and just really position themselves really well for users.
Very well said.
Yeah.
And I'd add one point on that as well. I was going through this example with someone the other day that was looking to buy an infill piece of land and build the equivalent of Class B. So it'd be new, but it would be with 22-foot ceilings, trying to replicate basically what an existing Class B building is. And once they went through the hard costs, soft costs, getting it fully built, running the pro forma, and then figuring out what the rents would need to be, they'd need to charge a 60% premium to build that, basically a competitive building to compete with the older stock. So most of these tenants, they're not overly concerned with being in a brand new building. They just want to have a space for their business. So to ask them to pay a 60% premium would be the equivalent of asking a homeowner or home purchaser to spend 60% more just to have a brand new house versus one that served the exact same purpose. So I love Class B for that reason as well. One thing I wanted to dig in deeper on, because this is a thing that I talk about all the time, is that the downside risk of industrial is bigger than any other asset class if you make a mistake. And I love how Hunt put this forward, that you need to look at what the building is worth vacant, especially if you've got properties with lower WALT, weighted average lease terms on there. You need to understand what that property is if it's vacant. And I think that holds true even if you have a 20-year lease in there, because things happen, companies go bankrupt. There's always a scenario where any property could come vacant. And if you're intentionally buying ones that have an upcoming lease, it's even more important. What are you looking at on the properties from that downside risk? Are there certain things that are just a hard no for you? Call like really low ceiling heights or marshaling area. What are the things that you're looking at in a property that are good? And then what are some of the things that are red flags that you just stay away from?
Um, Backing up, I think that's a great question, and I wanted to highlight one of the points that you made on the construction cost side. It's a conversation that we have regularly. I talked to a group this morning that's looking to build a building. They want a 30 to 40,000 foot building, and to build that building, you're talking about 140, $150 a foot. And then if you add outdoor paving and concrete yard, you're up $160, $170 a foot. When what we like about the space, and we think it's a unique opportunity right now, is we can go out and buy these buildings that serve a very functional purpose for, as Zach was saying, the users that are more infill. You can buy those buildings at, depending upon the market, 60, 70, $80 a foot. And you're able to, and a lot of times, because rental rates have run up so much over the past since COVID, and a lot of these markets have experienced 30, 40, 50+% rent growth. Any lease that was signed 3, 4, 5, 10 years ago is now dramatically below market. So if you can buy a piece of property on a cap rate basis with a $5 rent in a $7 market, your basis in that building is going to be 60 or $70 a foot. I mean, you're half of replacement value. Plus, you've got some upside already built in, because if it's a $5 rent in a $7 market, there's already 30 or 40% upside to that rent. And then, to the exact point you're making, Chad, how can anyone pencil to go build new construction right now? I mean, when you have to get 13, 14, $15 on a, depending upon the build out, even if it's 12 or $13, and market rents for new class A or new built class B is $8 or $9, that's such a premium over where the market is. It's very difficult to justify. So the point is, we think even if it's a $7 market today, we think there's some continued runway for future rent growth in these Class B buildings, because we don't see any change to the current supply in the near future, because it's just so difficult unless you're a user building a building for yourself, or you're a developer that's building a build-to-suit property for a specific use. It's so hard to justify a spec smaller building right now, that we just see very limited new supply coming online in the next 12+ months.
Very well said. I couldn't agree more.
Yeah. And then to
Yeah, go
further
ahead.
elaborate on your question and Hunt's points there, in terms of red flags that we, try to stay away from in the properties we're looking at, you mentioned ceiling height, and we try to look at, 20 feet and above, unless there's a compelling reason to look at a lower ceiling height for maybe there's a reason for it. Maybe it's a market that doesn't care as much about it. So we do look for that. We have this sort of rule of thumb that's, if it's a distribution building, um, one dock door per 10,000 square feet of warehouse space is just a general rule of thumb. I think we talked about that last time. So we look, kind of at that. And then, making sure that the office percentage is not, completely out of whack. We're not buying flex properties. We're not going to go buy an industrial building that's got 50% office space in it. So that as well. And then, if it's a super compact site, and it's got an FAR, floor area ratio of, 70+%, we might look a little more closely at that. What does that mean? Why is there so little excess land in comparison to the property? If it's a really infill site, we'll take a look at that. But as Hunt said earlier, we like to have excess land with our properties, whether that's improved excess land, or could be improved later by adding additional trailer parking and storage or things like that. So those are some of the things that we look for, and then just the functionality of the box, the shape of the building, right? Squares and rectangles are great. Triangles are not. It's sometimes just as simple as that. And making sure that you don't have a building that's really chopped up inside, lots of, different small rooms, or, mezzanine. So we've seen some buildings with mezzanine space that are kind of difficult to work around. And, you kind of tread lightly around that kind of stuff. So those are just a few of the things. Hunt, you might have some more to add on there.
Yeah, I think that's well said. It's just really generic versus overly specialized. We want as generic and what we call functional as possible. Having a couple dock doors, having some drive-in doors, having a sufficient truck court. It's not a lot of these, and I read a report last week about these tenants need to be it boils down to the location and irreplaceability of location. These tenants a lot of times need to be in these spaces, and it's really difficult to recreate buildings in these locations. So they're willing to make some. Is the truck court 95 feet instead of 130? Yeah, okay. Is that ideal? They can make it work though, because they need to be in these sites, and it's not a bulk distribution site where they're running hundreds of trucks a day. It's easier to make some of these things work on some of these smaller facilities.
Yeah, I love it. Darren Hoang from Tulsa is in the chat, and he had a question for you. Have you ever had a tenant need a railroad spur in your years of experience? And then he just elaborates, in Tulsa, our vacancy is sub 2%, but it still seems like the rent growth is not pacing. What needs to happen to equalize the supply demand? He's got three questions in here. Let's go back and we'll just ask the first one. Have you ever had railroad spur in your years of experience? Has that ever been a requirement from tenants?
We have one. Zach, you may correct me if I'm forgetting about one, but we have one property that's actually outside of Tulsa right now. And by the way, Darren's awesome. We know Darren well, and he's great in the industrial space. So appreciate the question, Darren. But yeah, we have a property outside of Tulsa that has a rail spur. It's critical to them, and it was a property that we purchased a couple years ago, really, really far below market rent. Was one that they had 3 or 4 years of term remaining on their lease, and they approached us early because of the criticality of that location to them. And that's the benefit of where we're at today. More and more users are becoming aware of the demand and of the rent growth, and really, the we always would want to avoid a situation where a tenant is up for renewal and there's sticker shock, that rent is dramatically growing, because that's not good for anyone. That's not good for their business and not good for a tenant landlord relationship. So they approached us early. We were able to renegotiate a dramatic increase on their rent, extend them to a much longer lease term, 10 plus years of lease term. But I think a big part of that was the rail spur in that facility is critical to them, and they use it every day. But we also see, it's one of those really unique things where maybe it's not a great example, but like a fully climate controlled building, or even really heavy cranes in a building, or oversized drive-in doors. There's some of these specialized features where if you have them and you find the user that needs it, it's a home run, because they kind of have to pay whatever the asking rate is to be able to utilize that, because the number of available rail spurs isn't many, but that pool of users that actually need it is pretty small. So if you get lucky and find the right group that needs a fully climate controlled space, then it's a home run. But we've typically seen on some rail spur sites, we've got another property that had a former rail spur. We could bring it back. It's pretty costly to bring it back, and we just haven't seen much of a need at all from anybody that was out there looking for it.
Yeah, and I would add on to that as well, is that I've seen a lot of companies, and I think this is driven by the railroad companies, is they're trying to push more and more companies to use intermodal facilities. It just makes it so much easier than having to service all these independent spurs and have side agreements with them. They're just trying to push a lot of companies to these intermodal yards. So that's on my radar, actually. If anybody's listening that's in the railroad space, either work for a company or one of the major railroads, or even just involved in an advisory role, reach out to me, because I think that'd be a fascinating conversation to explore in a separate one. And then if I could add just one more point on your thing there as well, Hunt, on the specialized building component, you make a really good point. If it's something over and above what the generic tenant might want, I think that's a huge benefit. an oversized door is a great example. It's still a door. It's still going to work for anybody that might need just a normal 12 by 14
Right.
door. But if it's oversized, then it could actually be a huge benefit for everybody, whether they use it or not. So I think that's a really good point to have on there. I'm going to turn this next one over to Zach because this is another. Darren had three great questions, so I want to get to
Yeah.
all of them. In Tulsa, our vacancy is sub 2%, but it still seems like the rent growth is not pacing. What needs to happen to equalize the supply demand?
Yeah, that's a great point. And Tulsa's not unlike a lot of other secondary markets across the country where you have this really supply constrained market. There hasn't been a ton of new spec development. There's been some in Tulsa, but it's still really low vacancy, and it's going to be like that for quite a while. And in terms of rent growth not pacing, I think we've all seen and we've read the articles about maybe demand for new industrial space amongst tenants has been slowing over the last 12 months or so. Um, the tariff situation and the overall state of the economy right now is I think making some companies a little bit maybe timid's not the right word, but maybe pressing the pause button for a second to see what's the new equilibrium going to be. So we've seen a little bit of that. But I'll tell you, in other markets, I mean, we haven't seen it in a lease rollover in Tulsa specifically lately, but in other markets where we're dealing with, negotiating new leases or taking properties out to the market for lease, we're continuing to get surprised by the rates that we're achieving on the rent, in terms of what we're seeing, what's being proposed, what we're negotiating to compared to what we originally underwrote, and it's continuing to be on the right side of the equation for us. And it just goes along with our investment thesis, right? There's just a lot of these tenants just don't have any other options when it comes to getting a good functional space, and they're willing to pay market rents, and market rents just keep increasing, at a faster pace than what we've seen. So, I think Tulsa maybe is just a market that it'll catch up, and I think the rent growth will continue as we move forward. But I certainly think that uh, supply and demand are balanced in a lot of these secondary markets, if not trending on demand still being outpacing supply by a significant degree. So if that's continues to be the case in these markets, it's only a matter of time before rents continue to kind of increase and catch up to what you might expect them to be.
Great point.
Yeah.
I'll the third question here. I'll let either one of you who want to answer it give it. He said, "How has private capital equity debt been reacting to Class B iOS and sale leasebacks?"
Yeah, great point. I can dive in on some of that, Hunt, if you want to
No,
follow
go
up
ahead.
there. I'll start first on the debt side, and in terms of what we do. I mean, we don't do a ton of sale leasebacks, especially long term oriented, 15, 20-year triple net lease sale leasebacks. So I'm going to set that to the side. But for Class B and iOS specifically, I mean, we're seeing continued really good debt options from a lot of what we use is conventional bank lenders, local and regional. But even with some of the larger, the Lifeco debt, CMBS, we're seeing good execution and good quotes from, lots of different sources. And so I think the debt world has really come around on, our product type here and iOS as well over the last 2 to 3 years, as being a really good alternative to the Class A institutional stock of product and the industrial space and just the overall thesis. I mean, I think these banks are catching up to the fact that this is a really good area to play in and diversify within the industrial commercial real estate world. So, um, the debt has been great, albeit we all wish interest rates were a little bit lower, but at least they haven't been rising significantly lately. But and then on the equity side, we're seeing it as well. It's people want to invest in industrial and they want exposure to industrial. And when we tell them the thesis, I mean, we have outside investors that invest with us. When we tell them what our thesis is and what the compelling reason is, and here's examples of 4 or 5 deals that we've round tripped that have the same exact strategy and theory. I mean, it's just that case in point, and people really enjoy being able to have exposure to alternative asset classes from a high net worth perspective. And then, family offices have been, really active with us as well, and even some RIA groups as well. So, a lot of our capital is non-institutional in nature, and that's by design. And we're putting a significant amount of our own capital to work in what we're doing. We really believe in the theory and the investment strategy. But it's been an evolving process, and it's fun as we grow as a firm and kind of increase our capital base, and just kind of get to have nice conversations with people about what we're doing, why we have a conviction around it, and being able to show them those success stories and then get them in a live deal or two, and then let them experience that firsthand. That's pretty fun.
Yeah, well said. Hunt, anything to add on that?
Yeah, Chad, I thought your conversation with Justin Horowitz a couple weeks ago was great on the debt side. He's the expert on the debt side in the iOS space, and we have experienced a lot of those similar conversations. I mean, even 3 or 4 years ago, Class B space as well as the iOS space, it was a lot more of an education process that we went through with lenders, and with even some equity investors. So as this space has grown in popularity and more and more folks get it, those it's I think we're having fewer conversations on the why and just more on where our specific niche within the industry is. So which I think is a great thing for everyone in the industrial space. As we've, the more the capital markets can be educated and want to play within this space, I think the better for everyone.
Yep, I love it. I completely agree with both of you, and Darren said the same thing too. Love it. Uh, Zach, you brought up tariffs. Let's dance on the topic real quickly. We won't spend a lot
Yeah.
of time on it because I've got other things that I want to ask you about. But with
Yeah.
that being the topic of the day, topic of 2025, to start with, what's your thoughts right now? What are you hearing from your tenants in regards to tariffs?
Yeah. And I knew I was going to get this question from a Canadian talking to two Americans here. So we can dance around it all we want, but let's just hit it head on.
I
um,
like it.
yeah. There's no doubt that it's just caused a lot of uncertainty, right? You see the headlines of, okay, we've got 25% tariff on automobile imports now. We've got, Trump's slapped tariffs on, a lot of Canadian goods and goods from Mexico, and 10% tariff on Chinese goods in addition to what was there before. You just read the headlines every day and you get a sense that, okay, is this real? How long is this going to last? Is this posturing? And I think we're all sitting there scratching our heads saying, okay, it's kind of a wait and see process, right? If these tariffs persist for a long time or a longer period of time than maybe a lot of our tenants are hoping, then we could have some real disruption in the supply chain, and inflationary pressures on material pricing, which will further confound industrial development, moving forward. And in one way, that's good for us in Class B buying existing properties, because if you have less development, it's going to continue to make what we're buying kind of more in demand from a user perspective. But if you've got that isolationist strategy persisting, and us bringing more manufacturing back to the U.S., that's really it's a long-term approach that's going to take some time to work itself out. And in the short term, I think you're going to have a lot of companies that are going to experience some difficulty with, you know, growing their businesses, or just continuing to operate the way that they were. And so it could cause some short-term disruption on, the need for industrial space, and maybe some companies hit the pause button for a second just to see what the new normal is going to be. So it's a situation that we're monitoring really closely. And I don't think anybody has a crystal ball to say, exactly how it's going to unfold and what's going to happen in the near to midterm. Um, but it's no doubt a topic that's on our tenants' minds. It's a topic that's on our minds. We're We're talking to, our equity partners and our debt partners about it as well. I think where Class B industrial sits is the prognosis is still pretty good because of that difficulty on rising material prices potentially in the near term. So I think we still set up pretty well with what we're buying, and we still have a conviction around that, even in spite of a a tariff ridden environment. But it's definitely something I don't think that we had anticipated. Having to deal with to this degree this early on in the new administration.
Hunt, anything you want to add on that?
No, I think Zach hit it. I mean, we've volatility is interesting, and we've seen it in the markets. Is that contributing to maybe some softness in terms of pricing from the buy side in the real estate world today? I don't, stability is, I think, a good thing, and hopefully that whatever is the case can be determined here in the near future, and then it can just be the new normal, and people can make decisions with better information versus kind of feels like you're guessing a little bit what will ultimately be in place even a couple weeks or months from now.
Yeah. That's a great point, Hunt. I mean, that's true for any market. It's easier to operate in a state of equilibrium or stability rather than in a volatile, daily changing roller coaster type of a situation. And so I think that's what everybody's trying to navigate right now is what is equilibrium, you know, what this roller coaster ride that we've been on. I mean, the stock market's down 500 points again today. It's pretty wild the swings that we're seeing in the economy right now. But yeah, when is that new normal coming and what's it going to look like? Let me know if you figure that out, Chad.
Yeah.
Well, I was looking to you guys for the answer on that. So I've got a little bit of a different approach on it. And there's some Canadians that are mad, and I'm sure there's
Yeah.
some Americans that are mad. Like you said, the stock market's been down. Anybody that holds any automotive related stocks, they're feeling it right now. I
Yep.
take I take the approach, first of all, that in 20 years that I've been in this industry, there's always something. There's always something chaotic happening at any given time that's
Yeah.
threatening the economy, that's causing people to be concerned about it. We went through the pandemic where the world shut down for several months. That was the most chaotic thing that I could possibly think of happening, and we
Yep.
made it through that. There was a little bit of pain and discomfort, but the especially industrial, soared through there, and the economy picked up right after that as well. So this,
Yeah.
in my mind, if you compare the two, a global pandemic to a tariff situation, it's not even on the same page. So it's bad. I don't like the unpredictability and the volatility of it, but I really don't think it's anything worse than what we've seen in the last 20 years, especially a pandemic. And then the
Yeah.
big reason on why I'm not concerned is that it will take 5 to 10 years to really build out the industrial plant needed to onshore everything to the US if that was the case. It would
Right.
just take
Yeah.
that long to build out that infrastructure to replace everything that's already built in other countries. And I don't think President Trump has a 5 to 10 year plan. I think I think he's got a 1 to 2 year plan. And his
Right.
legacy is not going to be wanted to drag the economy and the stock market through the tank. I think he's going to want to go out on a high note. I think he's wants to build his legacy. So
Hmm.
I think he's got short-term plans, but not, and he probably is. I don't discount how he's thinking long term, but it's a 5 to 10 year plan to build out that
Yeah.
industrial plant, and he's making decisions right now. I just don't think that they materialize. I just think that they're going to be very short lived. I think it's part of a negotiating and a posturing position where he's trying to leverage it to get things to work in the U.S.'s favor. And to that point, I think that that's what all countries should be doing. I think all countries should be focusing on their citizens, their country first. That should be the priority. And if anything, we encroach too much outside of our own countries. So that's the long and short of it from my perspective in Canada is that I just don't think that they're going to last that long. And even if they
Yeah.
do, we've been through far worse things than a tariff.
That's a really good point, and it just kind of rung something in my brain as you were talking. I mean, really, the bet on tariffs is that the short to midterm inflationary pressure that you're going to see from enacting them will be less than the long-term average GDP growth increases that you get from instituting the tariffs and bringing manufacturing and bringing goods and services back to your country as a result. And so, and that's the general bet. But you're exactly right, Chad. That takes so long to get worked out, right? And it takes much longer than one presidential administration to nearshore or onshore all the stuff that you would want to do, via the tariff strategy. So it will be really interesting to see how it plays out, and if it's to your point, I do think that Trump is going to want to do something that will have an impact during the term of his presidency. So I definitely agree with you there.
One thing for sure, it will be a very interesting 2025. Like
Yes,
it's reality TV playing out in real time.
yeah,
It's entertaining if nothing else.
that's exactly right.
So okay, well let's move away from tariffs, because I think we could talk about it, and most of it is just guessing anyways. We're just trying to stick a wet finger in the air and determine what's going to happen when we really don't know. All we can control is what we're trying to focus on, and I think that's like a natural spot to move into how you guys look at markets, because 150 markets is pretty impressive, and I'm guessing some of those you just wouldn't know that well. It'd be perhaps an opportunity comes up and then you really do a dive into it. What would that look like? Let's say somebody put a property in front of you in one of those markets that you perhaps don't know well, but it's a minimum 400,000 just 400,000 population base, and it ticks the boxes. How do you start diving into what one of those areas looks like?
It is a challenge from our standpoint. We've elected to cover all these markets versus going 100 miles deep in one or two markets, and that's where our relationships with the brokerage community in every market and markets across the country is so pivotal, and really where we felt like going back to when we were choosing to focus on Class B industrial, where we felt like we could have a competitive advantage given our years as investment sales net lease brokers. You really follow a lot of your clients around to different markets across the country because of the nature of net lease assets. A lot of times it's more focused on the credit and the lease itself rather than the real estate. If you're selling a 15 or 20-year CVS lease or Starbucks lease or whatever you may have. So we got really used to going into different markets and trying to understand them best we could, but also where we felt like our competitive advantage is, our partners at TrueCore, they've been in the industry for 30 plus years. We already had relationships with brokers in most markets across the country, and being able to tell that Stan Johnson company story, there was some name recognition. It gave us some credibility. So we had an ability to come in to a lot of these markets across the country and really, because there are folks that are local and regionally investing, there's not that many groups that are doing what we are doing on a national basis. So to be able to come in, we spend a ton of time really underwriting the market, and that's heavily reliant on brokers and comps data, not just lease comps, but sale comps, vacant, leased sales. What's the velocity in the market? What's the vacancy rate in the market? How much new development is going on the past 6 or 7 comps? How long were they on the market? How many tenants are in the market today that are looking for space in these size ranges that we are looking for? And we've had the opportunity to work with some really, really good brokers in lots of different markets. And they're tracking this. They're seeing, hey, we've had 1 million square feet of requests over the past X number of years. And look at this secondary market. There's just been so little new development. here I can rattle off 5 or 6 tenants that have had to go to larger markets in different areas because that space just doesn't exist here. So when we underwrite a market, we want to feel good about the tenant demand. And then we also spend a lot of time not just with the market itself, but the submarket within that market and understanding what are the industrial pockets, the differences in different industrial areas within the market, how the population growth and trends in each market relate to those separate industrial pockets within the market, and then just the functionality of the building. You know, even some markets, you go to a market like Dallas, and there's a lot more concrete tilt versus maybe a market, we were talking about Baton Rouge. That's a market where there's a lot more metal buildings. And in some markets, metal buildings get discounted and docked, but in others, that's just commonplace. And nobody cares really if it's a metal building versus a concrete tilt building. So we spend an extremely long amount of time understanding the market best we can. But that's all about the broker relationships that we have and that we try to form in each market to really underwrite these properties. And we can go into it a little bit more detail, but and you mentioned it earlier, Chad, but we're underwriting the upside, but really where we spend more time is on the downside and what that downside, how are different ways, what are the possible scenarios here? What are those ways out of the mousetrap, so to speak? What are the downside scenarios and what happens in those scenarios? Because honestly, that's one of my favorite parts of this asset class that we're investing in is these aren't, to the average investor, these aren't the sexiest of real estate assets. This is they're pretty basic metal and concrete boxes and maybe not the nicest parts of town. But we really believe in the downside protection that is available, and really relying on those brokers to just understand what that looks like if we get the building back vacant.
Yeah, I love how you doubled down on that because I can't emphasize that anymore myself. Is that downside risk is far more important than any pro forma where you can manipulate rent escalations, you could manipulate your exit cap rate, and you could have a pro forma look so great based on a lot of assumptions. But what happens if your downside risk is greater than that? So I think that's such a great point. I want to just turn it over to Zach for a second and ask about a market. And what are the fundamentals of a market that you're looking at? Is there 400,000 is the population that you mentioned is the minimum? What else are you looking for in a market beyond population?
Yeah, that's great. The other two things I think that we quickly try to size up when we're looking at any market is, okay, what's the current vacancy rate of the industrial stock, right? And more specifically, what's the vacancy rate of Class B industrial within that? And then what has the rent growth year over year been trending at for the last few years, right? So those things pretty quickly tell us a lot about the supply and the demand dynamics in the market before we even really are, take the time to talk to any brokers in the market. But then we'll follow that up with, okay, let's get some specific feedback on, what needs are out there. If it's a 50,000 square foot box, what needs are out there in the market right now that tenants are looking for plus or minus 50,000 square foot boxes, and how often do those come across in the market? So really the tenant leasing velocity is another big thing that we try to size up very quickly. And then another couple things, and I think we talked about this on our kind of pre-call yesterday. Really, the kind of the stability of the market, and what kind of insulation does a market have from economic uncertainties, um, is another interesting thing for us. And a couple deals that we just bought. I mean, we bought this deal in Baton Rouge, closed on a couple weeks ago. Capital of Louisiana, Louisiana State University is located there. You've got a employment base and a student population and just an economy that kind of revolves around the university there to an extent, where it's a little more insulated, right? If things go bad, you're still going to have the capital there, you're still going to have the university there, right? And that's a little bit more insulated from the highs and the lows of the economic situation that we might be in from a macro perspective. Um, we just bought a deal in Lansing, Michigan. Same story, capital of Michigan, halfway in between two largest markets in Michigan, Detroit and Grand Rapids. Um, good from a supply standpoint to both of those markets, and you've got Michigan State University there as well. So, just some other interesting things that we've been finding out as to how what are the other compelling reasons about some of these secondary market locations, and how can they um, maybe better withstand the boom bust highs and lows, maybe of some other larger markets, and that's pretty interesting to us. And then of course Hunt mentioned population growth and things like that. So we of course take that into effect. Region of the country, I would say that we're not all areas of the country are created equal for us. We all else being equal, we've tended to really like the southeastern markets, and we've tended to really like the midwestern markets. Just from what we kind of see happening now in those regions and moving forward in terms of being pro business and pro development and things like that. But we bought deals in the Northeast. We bought deals on the West Coast as well. So it's not like we're not looking in those specific regions of the country, but we just see some really compelling things going on from a, you know, from a from a pro business perspective in the southeastern and midwestern primary secondary markets that we look at. So
Yeah, that's great insight.
yeah.
And speaking on your investment philosophy, you guys recently moved to a fund model. So trying to raise money within a fund. Can you talk about that? And maybe I'll go over to Hunt first and then circle back to Zach.
Sure.
If you just talk about perhaps the decision and what that looks like to move to a fund model.
Go ahead.
Okay. Yeah, I'll take it. Yeah, so just an ever evolving kind of process on our end, right? To date, we started out as a smaller boutique investment company, investing a lot of our own kind of personal capital in deals. And as you just acquire more and more, and it kind of snowballs from there, and you get outside investors, high net worths, sort of the friends, family, country club approach. And then you keep growing from there. And we've got excellent, really valued high net worth investors and family offices that have really invested with us time and time again to date. We're just, we keep growing, right? It's a good problem to have that, our strategy is such that we're being successful and we continue to outgrow our capital base, so to speak. And so, we're always wanting to stay ahead of that. And so naturally, the fund model came into our kind of front and center as we were thinking about, okay, how do we continue this pace of acquisitions? We built this great machine to go source deals, and we're having a lot of success doing that, but how can we get a more efficient capital structure that's going to allow us to sort of rinse and repeat these acquisitions with a committed captive bucket of capital to go out there and move through transactions more quickly. And so really, that's why we're moving to the fund model. We're in the middle of our raise right now. We've already started deploying from it. Had our first two acquisitions um, for the fund actually earlier this month, and it's one of those things that I think is going to be good for us in the long term. If we were doing two or three acquisitions a year and buying $50 million industrial buildings per transaction, I don't think we'd have quite a need for a fund model. We just go out in there and get some larger capital partners. But, we're doing, at least 10 to 15 acquisitions a year, if not more now. Hopefully more this year for sure. And we've just got to be able to move quickly through those transactions and not spend our time raising capital on a deal by deal approach. So that it's been a great model for us, and I think it's going to be really good success. And we're sort of always out there talking to prospective groups that may have an interest in investing with us, and being part of kind of what we're doing. So that's really exciting, and another whole aspect of our business that we could get into on a whole nother tangent or episode, but that's just sort of a little primer there.
Very cool. Hunt, anything to add on that?
Yeah, as Zach said, it's helps us to be more efficient, and we love we like the diversification to that a fund affords different LP investors that are tagging along with us, and and as Zach said, from a deal flow perspective, it's been great for us to see as we've continued to build these relationships across the country and see the pipeline continue to grow. We're really excited for not only the volume of opportunities we're seeing, but how these opportunities are fitting what we believe is a really good return profile for what we are looking for within the markets we like. So we've closed 3 so far this year. We've got 4 properties under contract right now, and talking to different brokers in different markets regularly on a daily basis. So really excited for the opportunities that we are seeing from an acquisition standpoint this year, as well as seeing some, as Zach mentioned, seeing some round trips and leasing up some buildings that had some roll and being able to see us exceed underwriting there and even exit some and return capital and hopefully under promise and over deliver as much as we can in terms of our original underwriting. So we're excited about where 2025 is sits today and the rest of it and hopefully the volatility isn't too bad.
Very. I know we're at the top of the hour, but do you have an extra couple minutes for one question that came in from Eric?
Yeah, yeah, I just saw that. Yeah.
Okay, so Eric asks, is your eventual exit strategy to sell the whole portfolio as an upgrade or DST? And do you have any concerns or reservations that the fund model may force you to exit certain assets that you would want to hold long term?
Yeah, that's a great question, and I certainly have got this from people who are kind of new to us and looking to invest with us. The really interesting thing about what we do, Chad, in terms of how we underwrite deals, and this is within a fund vehicle and not in a fund vehicle, we have a specific business plan that we want to execute for every asset that we buy, and that includes the acquisition, what we're going to do to create value in the asset during our investment period, and then when we're likely going to sell it. And so the way we're underwriting deals in the fund is exactly the same. We're planning on selling properties at the stated time, within a 5-year window of acquiring the asset usually. And we're going to execute the business plan on an asset by asset basis, even within a fund vehicle. So it's not like we're doing this aggregate and sell to institutional capital. I think you have to rely on a lot of the moon and the stars aligning from that perspective, if you're going to execute on something like that. And this just allows us a lot more flexibility. Of course, we're open to something like that, and we'll always look at that. But we don't want to be forced that the only way that we can, execute the returns that we're promising to our investors is through, an aggregate and exit to, an institutional type capital. We want to be able to make sure the assets that we're buying stand alone, speak for themselves, and we can execute on a deal by deal basis. And then, to the second part of his question there, forcing us to exit certain assets that we would want to hold long term. You know, again, we're really not buying assets that we think we're gonna have to get stuck with beyond the business plan that we underwrite in terms of a hold period. And so, um, I don't think the fund constrains us there at all. The life timeline of what we're telling, publishing, and working on is within the investment period that we're underwriting for every deal that we add to the fund. So, really not a concern for us.
And it certainly doesn't hurt having extra options, whether it is
That's
selling
right.
to an upgrade down the road or just but maintaining each individual property as its own business case and its own business plan. I think that's a very prudent strategy.
That's exactly right. Yeah.
Cool. Well, I appreciate the question there, Eric, and for sticking around for a couple extra minutes. So different people might be reaching out to you if they wanted to hear more about the fund, talk to you about that, or if they have properties that they want to put in front of you, whether it's now or 18 months down the road, or even just kickstart a conversation. There's lots of reasons to reach out to you guys. So I'll put your contact information, TrueCore's website, and your LinkedIn in the show notes. And Darren said, great conversation. I couldn't agree more with that. That you guys always bring your A game, and it's a reason you're my favorites. As you could tell now, I said that at the beginning. You're some of my favorite guys, and now it's evident. Everyone can see why. So, Jen, thank you once again for taking the time to share such great insight with us.
Before we wrap up, I meant to ask you earlier. What's the? I've seen some teasing of the book that you're working on. What's your release date, or do you have one yet?
I do. April 7th, I'm going to have it for pre-launch, and May 1st will be the official launch date.
Awesome.
And I'll break the surprise right now. I thank both of you guys in the acknowledgement section, because I've learned a ton from both of you guys. So
amazing.
It's an honor getting to know you guys. So you got a small shout out at the beginning of the book.
Oh, that's great, man. Well,
thanks so much.
As Hunt said in the beginning, Chad, we really appreciate and value what you're doing for the industry, and it's just incredible being able to chat with you. And we hope we can see you in person sometime soon, and get together, break some bread, and have some good, more meaningful conversation.
Yeah, I can't wait for it either. And Hunt, congrats on the upcoming second baby as well. That'll be an exciting time in your life as well.
Yes.
Yeah. Okay, well, thanks everybody. Thanks Darren and Eric for the great questions as well, and we'll see you in the next episode.
All right, take care.
Thanks everybody.